Something has changed in their silver market and it's not making headline. Yet for major billion banks have altered how they operate in silver. Not the assets, not the exposure. The mechanism and that shift explain why silver is no longer behaving the way it did for most of the last decade. This is not narrative analysis, this is not subscription, this is a structural review. In this video, we document the specific trading tactics banks were fined for using the legal record that confirms those tactics. The current market data is showing why those tactics are losing effectiveness and the condition under which the paper market stopped controlling silver prices. For decades, silver pricing was dominated by paper volume, futures, option, and OTC contracts settled in cash. That system only works under one condition: physical supply must remain loose. As long as delivery is optional, paper claims can access physical metal without consequence. Banks use three primary tactics: spoofing, placing, and cancelling large order to steer price, time selling, dumping contracts, doing thin liquidity options, pressure forcing price into zones where contracts expire worthless. These tactics worked because delivery risk was low and inventories were assumed to be sufficient. That condition no longer holds. Bank short exposure remains large. Physical inventories are thin. The global silver market is running a multi-year supply deficit. Industrial demand is non-discretionary. Retail premiums are persistent, not episodic. When paper claims exist, a deliverable metal price separation becomes conditional. As delivery risk increases, banks adjust before headlines change. Aggressive subscriptions become dangerous when physical withdrawals accelerates. This is why price behavior near historical suppression zones now looks different than it did 5 years ago. To understand what happens next, monitor for signals. Comex registered inventory. The rate of drawdown matters more than the level physical premiums versus future prices. Commercial shorts postulating from CFTC data, price behavior near historical suppression zones. These signals determine whether the system stabilizes, adjusts, or fails. Under stress, silver is not being risk-priced. Emotionally, it's being repriced structurally. So stay alert.